Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lumentum.
If you find our talks useful, please consider subscribe, like, and comment underneath. Well, okay, let's unpack this because we are looking at an absolute rocket ship of a trajectory today. We're doing an extensive analysis of a company that currently sits right at the bleeding edge of the artificial intelligence hardware boom.
Yeah, it's an incredible setup.
It really is. I mean, we're talking about profound revenue growth, a rapidly shifting narrative on Wall Street, and a highly anticipated inclusion into the S&P 500. So the mission for our discussion today is to really look under the hood for you. We want to understand exactly how they pulled off these numbers, what their competitive advantage actually looks like in what is a notoriously cutthroat sector, and what the catalyst calendar holds for you over the next few months.
Right, and what stands out here, what you really need to understand about this, is that we're looking at a classic infrastructure play. During a gold rush, you don't necessarily want to be the one digging for gold.
You want to be selling the pickaxes.
Exactly. You want to sell the pickaxes.
Yeah.
But in the modern AI gold rush, those pickaxes are highly complex optical components. It's a foundational shift in how data centers are physically constructed from the ground up. And that is exactly the tailwind this company is capturing right now.
Let's start right there with the fundamental analysis, specifically the sheer scale of their recent financial performance. I was looking at their revenue chart earlier, and it literally resembles a hockey stick.
It does.
How did a physical hardware company manage to execute that kind of vertical leap in such a short time frame?
It's a striking acceleration, honestly.
Okay.
To put the exact numbers on it for you, in the first quarter of fiscal year 2026, they generated $336.9 million in revenue.
Okay.
And that alone represented a 58% year-over-year increase, which, I mean, most hardware companies would celebrate as a banner year.
Oh, absolutely. 58% is huge.
But then they reported their second quarter of fiscal 2026, and that revenue number essentially doubled. It hit $665.5 million.
Wow.
Yeah, that translates to a 65.5% year-over-year growth rate and nearly a 25% jump just from the preceding 3 months.
See, that quarter-over-quarter jump is what really catches my attention. What exactly is driving that? Because we all know artificial intelligence is booming, but what specific physical hardware are they shipping out the door to command that kind of cash?
If we connect this to the bigger picture, it points directly back to the insatiable demand from hyperscalers.
Right, the big tech giants.
Yeah, exactly.
Yeah.
When we say hyperscalers, we're talking about the absolute titans of the cloud computing world. Your Amazons, your Googles, your Microsofts. These companies are building data centers that span the size of multiple football fields, and they draw as much power as a small city.
Unbelievable scale.
And inside those facilities, you have thousands upon thousands of graphic processing units or GPUs that need to constantly talk to each other to train these really complex AI models.
And historically, those servers just talk to each other using standard copper wiring, right?
Right. But we've reached the physical limits of what copper can do. When you push that much data through a copper wire at those speeds, you encounter electrical resistance.
Which creates heat.
Exactly. Resistance generates heat, and heat requires massive cooling systems, which in turn require even more electricity. It becomes this vicious, highly expensive cycle. But more importantly, copper simply cannot handle the sheer volume of data required for modern AI at the necessary speed.
It's just too slow.
It is. So the entire industry is frantically pivoting to light. They're transitioning to photonics.
So instead of pushing electrons through metal, they are shooting photons through glass.
Precisely. It's the difference between trying to force a fire hose of water through a standard garden hose versus just building a massive frictionless canal. Lumentum is manufacturing the optical circuit switches and the advanced lasers that serve as those frictionless canals. They're providing the literal highways of light that make modern AI infrastructure function.
Okay, selling the highways of light sound highly lucrative, but selling more hardware doesn't automatically mean a company is making more money.
No, it doesn't.
Because hardware manufacturing is notoriously expensive. So what does this revenue explosion actually mean for their profitability?
That's where the story gets even more compelling for you. It is all about margin expansion and operational leverage. Let's look at their gross margins first, which is essentially what they make after subtracting the direct costs of producing these optical components.
Okay.
Their non-GAAP gross margins expanded from 32.3% in the second quarter of the previous fiscal year to 39.4% in Q1 of this year, and then up to a staggering 42.5% in Q2.
That is a very steep climb for gross margins.
Yeah.
But what about the operating margins? Because that factors in all the overhead, right? The research and development, administrative costs, the sales teams.
Yeah, and their operating margins climbed entirely out of negative territory to reach 18.7% in Q1 and then hit 25.2% in Q2.
Going from operating at a loss to a 25.2% operating margin isn't just an incremental improvement. That is a complete operational transformation.
It really is.
Help the listener visualize what that operational transformation actually looks like inside the business.
Sure. Think of it like a factory that costs $10 million a year just to keep the lights on and the machines running, regardless of whether they build one optical switch or 10,000.
Right, the fixed costs.
Exactly. Once they sell enough units to cover that $10 million fixed cost base, the profit from every additional unit they sell drops almost entirely to the bottom line. That's operational leverage.
And because they're selling so much right now.
Because the demand from these hyperscalers is so intense right now, their production lines are running at optimal capacity. Furthermore, they are selling a highly favorable product mix.
What do you mean by favorable mix?
Well, the hyperscalers don't want the older, cheaper tech. They're demanding the most advanced, premium-priced proprietary technology, which naturally carries a much higher profit margin.
And we can clearly see that operational leverage showing up in their core cash flow. I noticed their adjusted EBITDA, which, for those of you tracking at home, is a great metric for looking at the actual cash a company generates from its core operations before accounting for things like taxes and depreciation. That number jumped from just $37 million the year prior up to $127.6 million in Q1 alone.
Yeah.
They practically quadrupled their operational cash flow.
They've transitioned into a highly efficient cash-generating machine. And it shows in their earnings per share, or EPS. They posted an EPS of $1.10 in Q1, and then followed that up with an EPS of $1.67 in Q2.
And the consensus estimates for Q2 were only looking for $1.41.
Exactly, so they comfortably cleared that hurdle.
Which brings us to their forward guidance, which is arguably what Wall Street cares about most. For Q3, they're forecasting between $780 and $830 million in revenue.
It's a massive guide.
It is. If they hit the midpoint of that, we are looking at another 17 to 25% growth quarter over quarter. They expect those operating margins we just discussed to push even higher, hitting 30 to 31%, with EPS coming in between $2.15 and $2.35.
And add to that a highly stable balance sheet featuring $4.6 billion in total assets as of Q1. And it really paints a picture of a company that is firing on all cylinders.
It raises an essential question, though. When a company is posting 30% operating margins in hardware, it acts like a beacon for every competitor in the sector.
Oh, absolutely.
So how sustainable is this? Why can't a rival simply reverse engineer these optical switches, undercut them on price, and steal those hyperscaler contracts? I'm glad we're getting to this because hardware tech can be brutally commoditized. What is stopping the competition from eating their lunch?
Well, Lumentum's structural advantage stems from absolute leadership in highly complex proprietary intellectual property.
Okay.
We are talking about deep patents in high-speed lasers and a technology known as co-packaged optics. Co-packaged optics is the true game changer here.
Let's break that term down for the listener. What exactly does co-packaged optics mean in plain English?
Imagine you have a brilliant CEO that's your AI processor.
Got it.
And you have an incredibly fast translator who sends the CEO's messages to the rest of the world. That's your optical transceiver. Historically, the CEO and the translator sat in entirely different buildings.
Okay, so they're physically separated.
Right. And every time they needed to communicate, a courier had to run between the buildings. That courier represents traditional electronic wiring. It takes time and it takes a lot of energy.
So what does co-packaged optics do?
It essentially puts the translator on the exact same desk as the CEO. It brings the optical light connections directly onto the same physical silicon package as the electronic switch chip itself.
So you completely eliminate the distance the electrical signal has to travel before it gets converted into light.
Exactly. And by eliminating that distance, you drastically reduce latency. But more importantly, you significantly reduce power consumption.
And as we discussed earlier, power is the single biggest bottleneck for these AI data centers right now.
It is the ultimate bottleneck. If a facility physically cannot draw any more electricity from the local power grid, the only way to scale up their computing power is to use components that consume less energy.
And because this co-packaged technology is so deeply integrated into the actual physical architecture of the server racks, it must create incredibly high switching costs.
Unbelievably high. Hardware is notoriously difficult. It isn't like software where you could push a code update overnight and migrate to a new vendor. You're dealing with microscopic manufacturing tolerances, complex supply chains, and the literal laws of physics.
Right.
If a hyperscaler designs a billion-dollar data center around Lumentum-specific co-packaged optics, changing to a different vendor later would require tearing out the physical infrastructure. It is cost prohibitive.
Which means once you lock in a giant customer, they are essentially locked in for the life cycle of that facility. And looking at their recent customer wins, they haven't just locked in any giant. They have secured multi-billion-dollar commitments from Nvidia.
Yeah, and securing Nvidia is the ultimate market validation. Nvidia's own growth trajectory is essentially defining this current era of technology.
They're the poster child for the AI boom.
Exactly. When Nvidia decides that your hardware is the required standard for their AI clusters, you cease to be just a vendor. You become an indispensable co-design partner. Nvidia is physically building their next-generation architectures around these specific optical capabilities.
That partnership must act as a formidable shield against competitors in the space. Because companies like Coherent and Applied Optoelectronics are fighting for market share, but dislodging a vendor that is deeply intertwined with Nvidia's own roadmap seems highly unlikely.
It creates a virtually impenetrable moat for this specific product cycle. And it's obvious that the broader market is waking up to the reality of that moat. If we shift into the technical action and the sentiment surrounding the stock, the momentum is palpable.
Oh, it really is.
On March 10, 2026, the stock saw a 7.77% to 8% rise in a single trading session.
And looking at the charts from that day, it wasn't just a solo run either. It was part of a broader multi-day sector breakout. We saw peers like Ciena jumping 9% and Coherent up 7% alongside them. It really feels like a rising tide is lifting all the optical tech boats right now.
It absolutely is. From a trading psychology standpoint, this optical tech sector run reflects an accelerating price action driven by elevated trading volume. You have profound enthusiasm surrounding the hyperscaler AI build-out.
And that enthusiasm changes the market dynamics.
Right, it acts as a vacuum, sucking up available shares and significantly reducing the selling pressure. The market is collectively realizing that the much-hyped AI software revolution simply cannot happen without this very specific hardware layer.
The analysts have certainly caught on to that reality. We are seeing a major narrative shift across Wall Street, highlighted by substantial fair value target upgrades. Some targets are being hiked all the way up to $655.55.
Which is a massive revision.
Huge. And that kind of upward revision is heavily fueled by the confirmation of those multi-billion-dollar Nvidia ties. But beyond the analyst upgrades, there is a structural market catalyst happening that we really need to emphasize for you.
Yes.
Lumentum is officially joining the S&P 500 index.
The importance of that S&P 500 milestone cannot be overstated, as it fundamentally alters the ownership structure of the company. When a stock is added to the S&P 500, it triggers an automatic, mandatory wave of institutional accumulation.
Let's explain the mechanics of that for the listener. Why is it mandatory?
Think about the trillions of dollars managed by firms like Vanguard or BlackRock in passive index funds and ETFs.
The funds that just track the market.
Exactly. The entire purpose of those funds is to perfectly mirror the performance of the S&P 500 index. When the committee announces a new addition, those portfolio managers do not have a choice.
They have to buy it.
They cannot sit out because they think the valuation is too high, and they cannot wait for a dip. They are structurally required to go out into the open market and buy enough shares of Lumentum to match its new weighting in the index.
So it's guaranteed volume.
Yes. This isn't based on human emotion or daily news cycles. It is forced structural buying. It provides a highly supportive floor for the stock price.
Okay, so we have 65% revenue growth, locked-in tech giants, sector breakouts, and a wave of forced S&P 500 buying. Let's map this all out for you in a catalyst calendar so you know exactly what dates to watch over the next 3 months.
Good idea.
Because we have 3 major events clustered tightly together here. First, we have the Nvidia GTC conference happening in March 2026.
The Nvidia GTC conference is essentially the premier global event for AI infrastructure updates. While Lumentum's exact product announcements there might be speculative, the conference itself is going to loudly amplify the broader AI optical tailwinds.
But it's about the narrative.
Exactly.
Yeah.
Every presentation about scaling up data centers will implicitly highlight the need for advanced photonics.
Following right on the heels of that, on March 23, 2026, we have the official effective date for the S&P 500 inclusion. This is the exact date when that passive index buying catalyst we just discussed officially executes.
And then, looking just a bit further out into early May 2026, we have their Q3 earnings release. The consensus is going to be watching the tape like a hawk to see if they successfully hit that robust guidance of $780 to $830 million in revenue.
And that $2.15 to $2.35 EPS target.
Right.
Now, while all these micro company-specific catalysts play out, we also need to keep an eye on the macro environment. We cannot evaluate an infrastructure play like this in a vacuum.
We certainly cannot. And currently, the macro backdrop is surprisingly favorable. We are seeing calmer 10-year Treasury yields, which are sitting right around 4.11%.
Why does the 10-year yield matter so much for a company selling optical switches?
Because building out AI infrastructure is wildly capital-intensive. Hyperscalers are borrowing billions of dollars to construct these data centers.
So the cost of borrowing is critical.
Precisely. When Treasury yields are relatively stable and not spiking, borrowing costs are predictable. This gives the leadership at Amazon, Google, and Microsoft the financial confidence to continue executing their multi-year capital expenditure plans without fear of sudden interest rate shocks.
That makes perfect sense.
And that sustained corporate spending flows directly down the supply chain right into optical tech investments.
Okay, I want to play devil's advocate for a moment here because a chart that goes straight up always makes me cautious. We have to look at the risk assessment and build the bear case for you.
Let's do it.
When I look at the historical cyclicality of the semiconductor and optical markets, it's full of boom and bust cycles. Over-ordering happens. Furthermore, the biggest glaring issue seems to be execution risk.
Sure.
Ramping up physical hardware production to meet this kind of unprecedented demand is exceptionally difficult. If you look at peer coverage or even Lumentum's own analyst commentary, there is always the looming threat that product mix could shift unfavorably or that manufacturing lines could hit a snag. If a supply chain bottleneck delays a shipment by even a few weeks, it could significantly derail that profitability timeline.
It's a highly valid concern. As we said earlier, hardware is hard. You're dealing with microscopic manufacturing tolerances.
Right.
If a speck of dust gets into the wrong place on an optical assembly line, you're throwing away thousands of dollars of materials. A single disrupted supply chain component can halt an entire factory.
Which is terrifying for investors.
It is. However, the rebuttal to that immediate execution risk is found right in their latest earnings report. Delivering 65% revenue growth and crushing EPS estimates in Q2 is the ultimate proof of delivery.
They proved they could handle the scale.
Exactly. They aren't just presenting Wall Street with a hypothetical roadmap of future margins. They're actively expanding those margins by thousands of basis points today. They've demonstrated they can manage the complexities of this exact ramp-up phase right now.
I'll concede they proved it in Q2, but what about valuation concerns? Even with the impressive growth, when sentiment gets this hot and analysts are revising targets upwards so aggressively, you start to worry about a stretched valuation.
Valuation is always the tightrope walk in high-growth investing.
Right, because if the stock is priced for absolute perfection, any slight miss in that May earnings guidance, say they only hit $770 million instead of $780 million, that could trigger a painful pullback.
It requires balancing current multiples against future potential. But right now, the broader consensus view is that this premium valuation is largely supported by the structural factors we unpack today.
The index buying, mostly.
Yes. The impending S&P 500 inclusion provides a structural floor beneath the stock, as those index funds must maintain their positions regardless of short-term earnings misses.
That's a great point.
Furthermore, the multi-billion-dollar multi-year commitments from Nvidia provide a firm ceiling on how far revenues can actually slip in the near term. It's a highly unique scenario where the fundamental reality of the physical AI infrastructure build-out is actually keeping pace with the market's enthusiasm.
So synthesizing everything we've covered today, the fundamental metrics, the co-packaged optics moat, the forced index buying, and the execution risks, what is the final investment thesis here?
Based on our comprehensive analysis of the fundamentals, the competitive landscape, and the impending catalyst calendar, we are looking at a highly convicted 9 out of 10 bullish score.
Wow, 9 out of 10.
Yes. The core thesis for you is this. Lumentum is currently riding a profound wave of 65% year-over-year revenue growth, coupled with a complete operational transformation that is driving substantial margin expansion.
A true transformation.
This entire growth trajectory is anchored by the fundamental transition to AI optical infrastructure. Their position is cemented by invaluable co-design ties to Nvidia and impending structural market support via their S&P 500 entry.
So what's the timeline for holding?
With analysts lifting targets toward the $655 range, signaling potential undervaluation relative to those locked-in multi-billion-dollar contracts, the target horizon here is clearly a multi-year hold. You want to be positioned for the entire duration of the AI build-out cycle, while acknowledging there will be prime opportunities for swing trades around near-term catalysts like the March 23rd S&P effective date and the upcoming May earnings report.
It is a thoroughly fascinating setup. And as we wrap up today's discussion, I want to leave you with a final provocative thought to mull over. We spend so much time in the financial media talking about the raw computing power of AI, the relentless advancements in the processors and the GPUs themselves.
Constantly.
But as these massive data centers physically max out their capacity to handle traditional wiring and the immense power it consumes, could advanced optical hardware, things like Lumentum's co-packaged optics, soon become an even more critical bottleneck than the actual AI processors?
That is the real question.
Because ultimately, if you cannot efficiently move the data from point A to point B, the smartest, fastest chip in the world is essentially useless. It is definitely an angle to consider as you watch this sector continue to evolve. Thank you so much for tuning in to today's market analysis. We'll catch you on the next one.